Very good evening to you all, friends. I'm Sanjeev Singhal, Central Council Member and Chairman, Auditing and Assurance Standard Board and Chairman, Public Relation Committee. I'm also the Vice Chairman of the Sustainability Reporting Standard Board. On behalf of my Vice Chairman, C.A. Vishalbhai Doshi, and the entire Auditing and Assurance Standard Board, I welcome you all to this 105th program of AASB for this council year. Today's topic is Exposure Draft on SA 315 Revised. Friends, you would know that we have issued exposure draft of 7 auditing standards recently. And one of the auditing standards, a very important one, deals with the identifying and assessing the risk of material misstatement as an objective of creating awareness amongst the member regarding the possible implications of the revision in standard. We thought it will be fit to organize this program. And I'm happy that we are organizing this program in association with Chairman Sirsa, with the Sirsa branch of the Institute of Chartered Accountant of India. The Chairman C.A. Mohit Gumbar is here, and we are thankful to him for co-hosting this program. And we have the speaker for the day, C.A. Surinder Kumar, who is a technical expert and has been contributing a lot in many programs of the Institute of Chartered Accountant of India and in the technical literature. Thank you, Surinder. And thank you, Mohit Bhai, for hosting this program. Mohit Bhai, may I request you to give your opening remarks and invite C.A. Surinder Kumarji for his deliberation.
First of all, thank you so much, Sanjeev sir, for such a great initiative for enhancing the knowledge of the members. Thank you so much, sir. I also welcome to C.A. Surinder sir. आप आए सर, बहुत अच्छा लगा और आप लोगों की हमारे मेंबर्स की नॉलेज को बढ़ा रहे हैं लगातार, क्योंकि ये ऐसे टॉपिक्स हैं जो हम छोटे शहरों तक जो नहीं पहुंच पाते हैं, तो आप थ्रू वेबिनार के थ्रू आप हम लोगों तक पहुंच रहे हैं सर. आप लोग, आपका बहुत बहुत थैंक यू सर. I also welcome to all the members who are connected with us through this through the Zoom meeting. And now I'm going to introduce our today's speaker, C.A. Surinder Kumar. Surinder sir is a postgraduate in commerce and chartered accountant by profession, having 14 years of extensive experience in audit, internal control and finance reporting for large multinational and Indian corporate house across various industry segments. He had been associated with Big Four audit firms for more than a decade and have deep understanding of business process across various sectors. He is proficient in Indian GAAP, IFRS and SOX implementation. He has experienced regulatory reviews including PCA OB, direct experience with consumers and retail industries, industrial product, real estate, power sector, manufacturing and service industries. So sir, welcome again. Now sir, over to you sir. Thank you sir.
Thank you very much, Mohit, for the introduction, and thank you, Sanjeev sir, for giving this opportunity to me. I am aware you are doing a lot of things, and always you are giving opportunity to everybody to participate in this type of session. So thank you again, Sanjeev sir. Thank you, Mohit. I'm just putting my screen here, and I will quickly start the session without any further wait. Yeah, I'm just putting. Is my screen visible, Mohit?
Yes, sir.
Thank you. So let me start the session. So good evening and a very warm welcome to all of you. I'm Surinder Kumar and I'm happy to present this session on exposure draft on standard on auditing 315, identifying and assessing the risk of material misstatement. It is always a pleasure talking during this session for the learning of fellow members. Certain sessions on auditing standard were covered in past, for example, SA 265, SA 402, SA 260, etc. Today, we are going to cover an exposure draft on SA 315, and I believe that this is a very important standard when it comes to assessing the risk and the material misstatement at the time of assessing the risk. Considering a lot of regulatory increasing role of NAFRA, National Financial Reporting Authority, it is very important nowadays to have a proper compliance and documentation of auditing standard in audit engagement file. That is very, very important nowadays. I'll try to cover many practical aspects of documentation and frequently asked questions. Please keep posting your question in the chat box and I'll try to take as much as possible at the end of the session. So let's start with the SA 305 and I'm on next slide. Yeah. So this SC305, before I jump to directly to SC305, let me little bit talked about group of standard. So this SC305 is a group of standard which called risk assessment and respond to assessed risk. So there are total 6 standard in this category: risk assessment and respond to assessment risk. And let me spend little bit time over this 6 and brief introduce this six essays. So first is essay 300 that start with planning and audit of financial statement. So when we say planning, it means it start with the engagement acceptance. Even before engagement acceptance, the risk assessment of the client and the engagement is start there. Then it continues with the engagement letter signing, team selection, and risk assessment in the various factor at the client level. Now, second comes to SA 305, that is identifying and assessing the risk of material misstatement. That in any way we are going to cover in detail in today's session, so I will not touch upon right now. Third one is SA 320. Once we have significant risk assessment and assessing the risk of material misstatement, we have to plan materiality as well. So materiality may be earning, basis of materiality may be earning based materiality, revenue based materiality, or assets based materiality. So it is very important for the auditor to assess a reasonable level of materiality to do the audit, because in any case, audit is not a 100% certification. It is a reasonable assurance. So there may be a chances the risk will always be there, but we have to set up materiality, and based on that materiality, we have to, on sample basis, test the same. So that is detailed covered in SA 320. Now moving to the next one, that is SA 330, the auditor response to the assessed risk. So under SA 315, once the auditor has assessed the risk, the significant risk and other things, then SA 330 guide auditor how to respond to those assessed risk, maybe nature, timing, and extent of the audit. That is being covered in SA 330. Now moving to the next one, that is SA 402. So in case of an organization that is using service organization, so for example, for a large multinational company, the payroll processing is outsourced. So SA 402 guide us how to do audit in that case. Last one is SA 450, that is evaluation of misstatement identified during the audit. So once the audit is complete, the misstatements are there to evaluation, and the significant deficiency, material weakness, and other thing that is covered under SA 450. So overall, this 6 standard on auditing covered under one bucket: risk assessment and response to assessed risk, and guide auditor how to assess the risk, how to plan the materiality, how to respond to the assessed risk, nature, timing, extent, how to consider service organization report and other thing. Overall, this 6 standard will guide us. So now let me ask a question, because I want to be this session be very practical. So let me ask one question here. Have you ever seen this type of thing or response of the auditor, and where this auditor is being used this very frequently? So have you come across in your day-to-day operation, or maybe in any of your document which you are issuing? Have you come across? So please just write in the chat box if you have come across any of this responsibility statement, and are you using that in a day-to-day operation? Just put that in the chat box and I will move forward then. Okay, so let me reveal the answer. So this is a practical extract from an annual report of a company, of a listed entity. So in case of every company, be it a listed company, be it a private company, or any other company, so this report remains same. This responsibility paragraph, which says auditor responsibility for the audit of the standalone financial statement, consolidated financial statement, it will keep on changing based on the audit. So if you see the yellow highlighted one, the identifying and assess the risk of material misstatement of the standalone financial statement, whether due to fraud or error. So this is the exact thing which we are going to cover today in standard of audit in 315. Second one is obtain an understanding of the internal control relevant to the audit in order to design audit procedures. Last one is evaluate the appropriateness of accounting policy used and reasonable of accounting policy estimate. So this is the, if you see here, this report from a listed entity, and this is remain for the private company as well. So we on a daily basis using this type of reportment, where we give how auditor is responsible, to which extent auditor is responsible. These all are going there. So we are using this type of report in day-to-day operation. But if you see the genesis of this report, this is coming from this SA 315. So with this, I am moving forward to the next slide. So what is the scope and objective of this standard. So I will quickly touch upon on this scope and objective. This talks about identifying and assess the risk of material misstatement. That risk may be due to fraud or as well as errors. Though this standard covers aspect of fraud, however, a detailed coverage for this aspect is there is another standard, the fraud aspect of the audit responsibility toward further another standard, that is SA 240. The risk may be at the financial statement level. So when we say the financial statement, it is pervasive to the financial statement, or maybe at adjacent level. For example, inventory may not exist, or trade receivable may be not properly valuated, right? So this is the thing. This may impact overall business and continuity of the entity when we say this is the financial statement level, or the adjacent level, that particular adjacent may be impacted. The assessment provides a basis for auditor response to determine scope of nature, timing, and extent under another standard, that is SA 330. So under this standard, auditor has to assess the risk of material misstatement, and another standard SA 330 where auditor has to determine what is the nature, timing, and extent of the risk assessed, right? Now moving to the next slide, that is risk in context of an audit. So let me cover quickly what is an audit risk. So audit risk are risk to opine inappropriately on a financial statement where material misstatement exists. So there is a risk that auditor has opined or is going to opine on a statement where material misstatement exists, but auditor is giving the unqualified opinion or maybe a non-modified opinion. So the overall objective of the audit is to reduce the audit risk to an acceptable low level. So I have already touched upon, because this is a reasonable assurance and it cannot be 100% assurance in any case. So there must be some risk in the financial statement at the time of opinion, but that risk should be acceptable at the a low level. So let's understand this in a more detail. So audit risk is in the right hand side on the slide. Audit risk is a multiplication of inherent risk, control risk, and a detection risk. So inherent risk is the susceptibility of an assertion about a class of transaction, account balance, or disclosure to a misstatement that could be material. Material may be either individually, the error itself, or may be aggregated with other misstatement or other errors before considering of any related control. So this is inherent risk. So if I touched upon the simple words, so inherent risk are the risk which exist in the process. For example, there is a risk inventory may not exist as of the reporting date. So there is a risk of existence of inventory. Trade receivable valuation is not correct. So there is a risk trade receivable are not valued appropriately. There is a risk of collection from the debtor, but those has not been provided for. Or even trade receivable does not exist. So sale has been booked, but that sales itself is not exist as on the reporting date or maybe during the year. Revenue cutoff may not be adhered. So post-period revenue has been booked during the current year, and so on and so forth. So this will continue. So these all are the inherent risk when we talk about this. So in this exposure draft, by quickly touching upon, so this is a new addition in the exposure draft as compared to SA 315, which is in existence as of now. So inherent risk factor may be qualitative or quantitative. Qualitative inherent risk factor may include complexity, subjectivity, change, or uncertainty. So maybe when we assess an inherent risk, so we consider both quantitative as well as qualitative factor. So qualitative factor is not so simple to assess because there is no number format or something number like you may above this number this is material, below this number this will not. But qualitative factor number may not be so material, but overall transaction, the complexity of transaction, subjectivity involved or the estimation involved may be sometime so material based on the qualitative factor in risk may be higher at that point of time. So last one is the other risk factor. Inherent risk factor may be like quantitative or qualitative significance of the class of transaction, account balance, or disclosure. For example, disclosure of the executive compensation, right? So that is a disclosure. So auditor may assess that this is not a significant risk when assessed as a significant risk per se, but that disclosure may be so material to the financial statement for the stakeholder of the financial statement that should not be missed in any way. So that may be material but not a significant risk, right? So that is a qualitative aspect of that. Now move to the second one, the control risk. So control risk is the risk that a misstatement that could occur in an assertion. So for example, inventory may not exist, but the management has a control to do a physical verification of inventory at the year end, right? But after that control also, if something is not captured, not like detected maybe, right? So that is a control risk if after implementation of control as well, some misstatement happen. So to complete this example of inherent risk, so there is a risk that inherent risk that inventory may not exist at the balance sheet date. So this is a risk. The control is that at a reporting date, a physical verification of 100% inventory is there. So that is a control designed and implemented by the management. But what happened in case of after this physical verification as well, some misstatement is there. Maybe physical verification was not operating effectively, all the location was not covered, or the method adopted by the physical that was not appropriate. So there is a risk after the implementation of control as well, that control is not operating effectively. So that is a control risk. Now comes to the last one, that is a detection risk. So when we talk about detection risk, so this is the byproduct of inherent and control risk. So in a company where inherent risk and control risk both are strongly implemented by the management, the process is so strong, all the control procedure, standard operating procedure, all are there. In that case, detection risk would be low. So auditor has to do a little less testing in an entity where this type of controls, this type of process and other things are in place, as compared to one other entity. If I compare where these processes are weak, controls are not properly implemented, or maybe designed but not operating effectively, in that case detection risk will be high, because auditor has to do extensive testing to mitigate their risk. Because irrespective of what controls and design management has, but when it comes to the opinion from the auditor side, so auditor has to assess all these factors. And if a process is weak but still auditor seems that they can do additional testing, maybe cover through additional testing, then in that case also this opinion would be reasonable assurance only. So auditor has to see the detection risk after considering the inherent and control risk assessment from the management side. So now moving to the next slide, this is on the component, some of the definition which is there in SA 315. I would like to cover 3-4. This is more critical. One is the adjacent side. So adjacent is basically a representation from the management when they prepare the financial statement. For example, inventory existence, trade receivable existence. So when this number is there in the balance sheet, for example, inventory and trade receivable, so management adjusts to the auditor, look, this inventory exists and the valuation which have been done for the trade receivable inventory, that is correct. So this is the adjustment which management provides through the financial statement, and auditor has to do their auditing based on the auditing standard on that. So that is one. Second is the business risk. Business risk may be from any significant condition, event, circumstances, action or inaction as well, that could adversely affect the entity ability to achieve its objective and execute its strategy. So for example, business risk may be liquidity to an entity, that liquidity is not available, or maybe current assets is less than the current liability, and apart from that the company don't have a secured line of credit from any bank or financial institute. That may be a business risk to an entity, the lack of liquidity. Moving to the significant risk. So significant risk side, so when a risk is there, that is there, when we call the risk a significant risk, when the magnitude of the impact is very high and likelihood of occurrence is also high. So for example, there is a risk, for example, a company is there which is there in maybe manufacturing of a product that needs the oil, right? And when they use this oil, it keeps on seepage on in the earth, right? So there may be an environmental liability once it comes to the regulatory aspect of the environmental liability. So that impact of that seepage of oil in the earth may be very, very high to the company, and because the nature of the product is such that the likelihood is also very high, because this oil keeps seepage in the earth, and the likelihood of that risk being materialized would be very, very high. So if both this condition, magnitude of the risk as well as the likelihood of occurrence is high, so that risk may be considered based on the professional judgment or the auditor, maybe a significant risk. So now comes to the last on the control side. So when we talk about control, so it's policy or procedure that an entity establishes to achieve the control objective of the management or those charged with governance. So it includes both direct control and indirect control. So direct control may be like that is directly given assurance on an assertion. So for example, again in the same example, inventory existence, physical verification of inventory, that is a control, and that give direct assurance to the assertion that inventory may not exist, right? Some other control may be indirect control that may be helpful in supporting of the direct control. So that is there. Next, moving to the next slide. So let's come to the risk assessment procedure and related activities. So some of the aspect like inquiry may be there, analytical procedures may be there, observations and inspection may be there. Let me cover this in detail because this is very important. So inquiries directed towards those charged with governance may help the auditor understand the extent of oversight by those charged with governance over the preparation of financial statement by the management. So when inquiries is being done with those charged with governance, that will be helpful. Effective two-way communication assists the auditor to obtain information from those charged with governance. Second, inquiries of employees responsible for initiating, processing, or recording complex or unusual transaction may help the auditor to evaluate the appropriateness of the selection and application of certain accounting policies. Inquiry directed towards in-house legal counsel may provide information about such matter as litigation, compliance with law and regulation, knowledge of fraud or suspected fraud affecting the entity, warranties, post-sales obligation arrangement with business partner, and the meaning of contractual terms. Inquiry directed towards the marketing or sale personnel may provide information about changes in the entity, market strategies, sales trend, or contractual arrangement with its customers. Inquiries directed towards the risk management function or inquiry of those performing such roles may provide information about operational and regulatory risk that may affect financial reporting. Inquiries directed towards IT personnel. So when I'm discussing this type of thing, these all are the inquiry procedures. So under this standard, auditor needs to discuss with different people, different department heads, what is the their knowledge about the any suspected fraud, any significant matter that they want to discuss with that. So that is the thing, like different people maybe for towards with IT personnel may provide information about system changes, system or control failures, maybe change management system, change manage access system of the IT system. Inquiries with plant head may provide very useful information about capacity utilization. One of the aspect like environmental aspect, if something is there in our example, like seepage of the coal in the earth. Inquiries with internal audit may provide a good insight for key risk and overall effectiveness of the control environment. So this is on the inquiry procedure that is to be done with the different legal head or different departmental head by the auditor, and auditor has to document that thing in their documentation when and how this inquiry procedure were done, and do this inquiry procedure impacting my risk assessment. Now moving to the next one, that is an analytical procedure help identifying inconsistencies. So for example, there is a draft financial statement which is being provided at the planning stage, and if auditor compare those with the corresponding period or maybe extrapolate that, so those may be helpful in unusual transaction or event and amounts, ratios, and trend that indicator matter that may have audit implications. So by this analytical that can be identified. Unusual or unexpected relationship that are identified may assist the auditor in identifying risk of material misstatement, especially risk of material misstatement due to fraud. Analytical procedure performed as risk assessment procedure may therefore assist in identifying and assessing the risk of material misstatement by identifying aspect of entity of which the auditor was unaware, or understanding how inherent risk factor such as change, effect, susceptibility of assertion to the misstatement. Auditor can also take the understanding of entity by observation and inspection, which include physical presence at the location. For example, auditor may obtain an understanding of control over an inventory count. So at the time of inventory count by the management, auditor may be physically available there and can observe the counting procedure, counting methodology, and how the management is going to count that inventory. The auditor may be able to observe segregation of duty by physical presence also. The auditor may be able to observe password being entered in the system. That can also be done at the physical availability of the auditor, that will cover under observation and inspection. So in short, in this slide, this is risk assessment procedure and related activities, how auditor is going to do that. So that include inquiries, that include analytical procedure, that include observation and inspection. So alone, single item like only inquiry will not suffice, only analytical procedure will not suffice. So auditor has to do a combination of these three, or maybe more than these three, which is there suggested in the standard on auditing. So based on this, the auditor has to perform this procedure, and after that they have to assess the risk of material misstatement. Now I have a question here. Let me put this in the chat. Is it necessary to document how and when these inquiry procedures were performed and risk assessment based on said procedure? So is it necessary? The answer, please give the answer in yes or no in the chat box, and then we will discuss in detail how this question is important and what is covering here. So let me quickly see in the chat box. Mohit, chat box is open to everybody, right?
Yes, sir.
Okay, no issue. Okay, so let me quickly reveal the answer. So this is yes. So whenever a discussion is being done with any of the responsible person in the entity, be it a plant head, be it internal audit head, internal control, CFO, CEO, or maybe those charged with governance, or any significant position in the entity. So that inquiry procedure is to be documented. So maybe date, time, and when this procedure was done, and what was the question asked, and what is the responses received. That is being documented, and based on that documentation, if auditor believes that there is something on the impacting risk side, so maybe the assessment is to be changed, or it is to be modified somewhere, or maybe whatever way it is impacting this inquiry procedure, that is very critical to document, because considering nowadays this regulatory requirement and other things, so this is to be presented as and when required by any regulator. So this is very important. Most of the time it happens, particularly in the tier 2 firms, we do everything right, we do every procedure and other thing, but somehow our documentation is not so strong, and when it comes to the presentation to the regulatory authorities, so at some time it happens like we don't have a documentation. So that is very important to document. Now moving to the next slide, that is understanding the entity. So there may be many factors which auditor can consider while understanding the entity. So under this standard, while understanding the nature of the entity and other things. So nature of the industry play a significant role. Is it a manufacturing industry? Is it a real estate industry, civil aviation, etc.? Even within industry, there may be a different risk. For example, like an entity business model may rely on the use of IT in different ways. So for example, the entity sells shoes from a physical store and use an advanced stock and point of sale system to record the selling of shoes. So this is basically a brick and mortar store where the physical people come and buy the shoes. But same on the same and the same industry where the entity is selling the shoes, but the selling is through online. So sales transaction are processed in the IT environment, including initiation of the transaction through a website only. For both this industry, the business risk arising from a significantly different business model would be substantially different. Though somebody can say, or some people can say, both the nature of the business is same. They are in the business of selling of shoes only, but the risk assessment may be very different considering the IT system involved and the way of the business model, you can say. So that is another way to look at that. So maybe the second one is the regulatory environment. Impact an entity in many ways. There may be different type of restrictions and compliance, including price control. For example, price control in sugar industry, oil and gas industry, export and import restrictions in certain industries. So auditor has to be very careful while assessing the entity environment. So that includes the regulatory environment. A very interesting example for a manufacturing industry. So let me discuss this. Is very interesting. So where an entity A which provides its product to a defense industry, say in country A. However, because of its parent entity that provides the same or a similar product to the defense industry of country B, and those country A and B may be against each other. So because of this, the country A defense industry banned the product of that particular industry, that we will not be able to buy any product from you because your parent company is providing the similar product to our rival side, or maybe the country that is against us. So this type of things also happen in a practical situation when auditors start looking those aspects, and how this may be a biggest risk if the concentration of those product is particular to that defense industry only. The product can be sold to the defense only. There is no other buyer for those products. So maybe it comes to the winding of the business also. So this type of things is very interesting to understand when it is actually on the audit side. So financial reporting framework impacts the risk assessment process significantly. For example, different reporting for or different you can say accounting standard for banking and insurance, NBFC and other companies. Auditor need to assess organizational structure and funding. The entity may be closely held with a very few owner, nothing from the borrower side, no loan from a bank or a financial institution. Other hand side, the entity may be very big on the listed entity with large shareholder base, or it may be a startup with a private equity and investor. So each of these industry, privately held, listed, private equity or investor held company may have a different type of risk, which auditor has to consider while assessing the risk. So the same risk umbrella cannot be implemented at each client. So whenever auditor is taking understanding, and it is very important when this is the first time of the audit or the first year of the audit. So because auditor is new at that entity, and at the first year of audit, auditor has to understand all these aspects. So that is very important. So maybe another example, for investment in an entity, the risk may be different, and so this all things combined impact the overall risk assessment procedure of the auditor. The entity business model also impact the risk assessment procedure. Startup yet to establish process and product and may have different risk as compared to other established business. IT impact risk assessment process significantly. A totally manually process driven entity as compared to a complex IT structure where ERP is implemented and other things are there. So nature, timing and extent of those risks may be totally different. Moving on the next slide. So here is a question again. So can auditor use external source of information while assessing the risk of material misstatement? So just put your answer in the chat box and then I will take it. Can auditor use external source of information while assessing the risk of material misstatement? Okay, let me move on this. So the answer is yes. So auditor can use internal as well as external source of information. So in this matrix, one side is financial information that auditor can use from the internal source as well as external source. So internal source for financial information may be financial statement of the entity, past period financial statement, budgets of the entity, internal report and monthly information system of the entity, minutes of various meeting, maybe like a board of meeting or audit committee meeting or something like that. Statutory written filed by the entity, estimation process, etc. while having this observation and understanding of the entity. External source of information may be industry information, credit rating agencies, some information from the creditor, statutory authority notices, etc. And media and other external parties can be the source of external information when it comes to the financial information. Now comes to the non-financial information. So non-financial information, internal source can be business strategies, organizational structure of the entity, minutes of the meeting again, operating performance, policy, procedures, and manuals. And when it comes to the non-financial information and external source, so that can be trade association or industry forecast and similar other information. So there is no single source of information which helps auditor to assess the significant risk or risk assessment to identify the material misstatement. So there is no single source that can be internal, that can be external, and in internal, external as well, that can be financial as well as non-financial. So auditor has to make a combination of all this information while assessing the risk. Moving to the next slide, that is on identifying and assessing the risk of material misstatement. So both sides, one is the financial statement level and second is the adjustment level. So when I talk about financial statement level, so this is a pervasive risk which is all across the financial statement. So this is not particularly relate to adjustment. So for example, inventory may not exist, that is the adjustment level. But when we talk about the financial statement level, so it may impact financial statement as a whole. So auditor is not identifying a particular risk to a particular adjustment level. That may be done through maybe management overriding of control. So whatever the control being implemented, that may be override by the management. Deficient control environment itself, so management lack of competence when it comes to the control framework, when it comes to the internal audit function and other thing, that is not properly implemented, and that is a weak. Integrity of entity management play a significant role when it comes to the financial statement level. So if the management is not ethical or code of conducts are etc are not adhered with, so that comes with the financial statement level risk. Concern about the condition and reliability of an entity records, or maybe some business risk that is so pervasive to the financial statements. Maybe, for example, what happened to the airlines industry, 2, 3 airlines in the past. So that may be indication for other airlines as well while auditing those airlines. That type of risk may or may not be there, but that for sure a factor to be considered. So that is a financial statement level risk. The auditor has to identify and assess risk at the both. One is the financial statement level, second is the adjustment level. When it comes to the adjustment level, so it may be class of transaction, it may be account balances at the balance sheet date, or it may be disclosure. So in the next slide, let me quickly cover in detail adjustment level risk. So when I talked about PL side, class of transaction, so it may be occurrence risk. So when we say about occurrence, so it means transactions has been recorded that has not actually been take place. So there is a sale that is a dummy sale that has not actually don't have a contract, actually don't have a debtor itself, but that is a dummy sale that has been booked. So that comes under the occurrence assertion. Second one is completeness. So whatever sale or whatever transaction take place during a particular period, or maybe say within a year, that has not been booked. So completeness is an issue. When it comes to accuracy, so whatever is a transaction that was not measured accurately. For example, the transaction is to be booked for maybe 100,000, but that measurement of the transaction was not correctly done, and that was for 110,000 has been booked. So that is an accuracy side. Cutoff, when we talk about this, comes to a reporting period cutoff. So the transaction which is to take place in a particular year, that should be booked in that particular year. So maybe the transaction is there, but that relates to next year, so that should not be booked in a current year. So that is a cutoff adjustment. Last one on the class of transaction side, PL side, is classification and presentation. So wherever that transaction is to be clubbed or presented properly as per Companies Act requirement, as per auditing standard or accounting standard requirement, that should be classified and presented there. When it comes to the account balance sheet, that is the balance sheet side. So one assertion is existence. So maybe like, for example, some balances had been shown, for example, inventory, trade, receivable, fixed asset, but those assets actually not available in existence or physically not available with the management. Inventory is not there, trade receivable, dummy sales are there, fixed assets are no longer available with the entity. That all comes under existence. Second one is a rights and obligation. So whatever account balances are being presented, so company has a proper right, proper ownership of those assets in terms of title and other thing, and all other obligations. So, for example, fixed assets has been hypothecated, or maybe some loans has been taken as a guarantee to those fixed assets. So, those should be properly disclosed. That comes under right and obligation. Now comes to the completeness. This is same. All the balances which pertains to a particular period, those should be booked. Valuation, very important when it comes to the valuation. So all the assets, all the debtors, inventory, whatever it is, those should be valued as per all the investment that as per the accounting standard. So if it is not done, valuation is not appropriate. So that comes adjustment as a valuation. Classification and presentation, same, which I covered in the class of transaction. Same for the disclosure, occurrence, completeness, accuracy, cutoff, classification, and presentation. So what I have covered, I'm just moving back to the previous slide. So one is the risk assessment at the financial statement level. Second, as the adjustment level. So adjustment I have covered in the next slide, where class of transaction, account balance, disclosure. The different adjustment may apply for a different class of transaction, different class of account balance, or maybe a combination. So for example, completeness, it is there both for balance sheet as well as class of transaction, or you can say PL, both sides it is there. Now moving to the next slide, that is on the system of internal control. So that is again very important slide when it comes to the system of internal control. And let me discuss this. I have 2 slides on this, and let me discuss this in detail. These 5 pillars of the control. So when it comes to the Achievement through internal control. So what we are covering here? We are covering here, one is effectiveness and efficiency of operations, reliability of financial reporting, compliance with law and regulation, risk identification and management, and the safeguarding of assets. So these five are the basic, you can say, principle when we want to implement a control, or we want to implement a control framework. What we want to achieve? We want to achieve all these five. So in other words, if I say what else, so nothing else. So when we implement a control framework, so this is for all this. Maybe it may be effectiveness and efficiency of operation, it may be reliability of financial reporting, compliance with law and regulation, risk identification and management, and safeguarding of assets. So let's discuss these five pillars. So first is the control environment, basically entity level control, ethics, compliance, value and vision of the management, and code of conduct. Another thing, how company behave in a particular or maybe apply code of conduct and other things. Risk assessment process, I will cover in detail in the next slide, all these five pillars. So this is the just brief here. Risk assessment process of the entity control framework, enterprise risk management system, monitoring the system of internal control, internal function, evaluation of deficiencies, information system for recording and presenting the transaction, communication between management and those charged with governance, that covered in the information system. And last one is control activities, that is control over significant risk and unusual transaction, maybe passing of the JE and other thing. Now comes to the next slide. This is on in detail on the system of internal control for these five pillars. Let me discuss in detail, because this is very interesting as well as important. So first is a control environment. So auditor has to assess entity level controls, which will include management and those charged with governance, ethical values, vision, mission statement, organization roles and responsibility, oversight by those charged with governance. So whatever is the day-to-day operation management is doing, is there a oversight by the management, maybe on a quarterly basis or maybe more frequent than quarter. HR policies and conduct, code of conduct of the employees, trust charter, whistleblower, etc. All this cover in the control environment. How effectively vendor and supplier are being communicated for ethical behavior? Can they do something? There is a trust line, there is a whistleblower mechanism available. They can report if they find something unethical behavior. Employees trainings for ethical and code of conduct behavior, tolerance over wrongdoing. So if some case are there, some incident is there, it is being reported. So all this covers under control environment, and the business conducts, how business conduct policies are there, conflict of interest policies are there, maybe anti-corruption, bribery policies are there. So that all cover under the control environment. So when auditor comes while assessing the risk of material misstatement, identifying the risk, so auditor has to assess all these things. What is the control environment of the entity itself? So it will also cover independence of different function, for example, internal audit function and compliance function, direct reporting to the board of director or those charged with the governance, right? So how effective is internal control and whistleblowing mechanism of the company, the case investigation process, the independence of the case investigation process, all this again cover in the control environment. Now moving to the next pillar, that is risk assessment procedure. So management process for identifying business risk relevant to financial statement, identification impact and likelihood of those risks, identification of significant risk, assessing key risk driver and risk indicator with mitigation plan. So that will be covering there. Management system of internal control, this include how effective internal control process is, including internal audit function, evaluation of internal audit observation, monitoring of effectiveness of controls. So for example, an entity where internal audit observation are not actioned upon, or say not tracked for closure, and future action plan is not being there, will have weak system of internal control as compared to an entity where internal audit function directly reports to the those charged with governance, observations are being tracked and actioned upon for the closure. So definitely there is a difference between these two entities where this type of difference are there. So definitely the entity where internal audit function is independent, reporting to the board of director, those charged with governance, and observation are being tracked. So there the internal control function would be definitely be strong as compared to another entity. Moving to the information system, so this comes or include all flow of information within the entity. So IRPR basically starting from the initiation of a transaction, recording of transaction to processing, and finally reporting to the transaction in the financial statement. So it will cover that. How effective the communication is between management and those charged with governance, how frequently they are meeting, or maybe quarterly basis or before that. This also include external communication between various external stakeholders, including auditor and regulatory authorities. Last one is the control activities. So this include entity control function for managing a significant risk, control over, for example, journal entries. So maybe how effectively journal entries are restricted. Minimum journal entry can be posted. Control over non-routine transaction, including merger and acquisition, integration gaps, and other things. So it also includes segregation of duty implementation and control over IT control. This IT control may be both ITGC, IT general control, and IT application control. Moving to the next slide here. This is on discussion between the team members. So when the auditor is assessing the risk, so engagement partner and other key engagement team member shall discuss the application of applicable financial reporting framework and suspectability of the entity's financial statement to material statement. So this is important. Now one question here, is it necessary to involve all team member in the team discussion? So based on this standard requirement, I'm just repeating the question, is it necessary to involve all team members in the team discussion? You can quickly put your answer yes, no in the chat box, and then I'll discuss this, what is the requirement of the standard. Yeah, moving back. So though it is a requirement and it is expected and all engagement team members are involved, but because of any reason all team members are not involved, so engagement partner and the key engagement team member has to decide which are the matter that is to be communicated, maybe not at that point of time at discussion, but on a later date that needs to be communicated to members who are not there in the discussion or maybe the team planning event. Moving on the next slide, that is also very important, reassessment of ROM. So there is a question, is it possible to reassess risk of material misstatement? So again, this is a question to everybody. Just think whatever we have discussed as of now. So do you believe that a reassessment of risk of material misstatement possible or not? Okay. So in case auditor obtains new information that is not consistent, or maybe you can say other way, inconsistent with the earlier assessment, so definitely this is a dynamic and continuous process based on the observation of the auditor, based on the other factors, other information. This assessment needs to be continuously monitored, and if something happens or something new information is there, that should definitely be reassessed. Okay, that is another important topic of documentation. So you can just focus on the highlighted in red. If it is not documented, this is not audited. So basically, when it comes to a regulatory review or other things, so auditor has to present at that point of time the documentation. Based on that documentation, an independent person who has a equal knowledge or maybe competent person can have the same opinion that has already been signed. So if it is not documented, everything is being done, but the documentation is not there. So this is not audited, basically in simple terms. So what is the documentation requirement here? So one is the discussion among the engagement team and the significant decision risk. So whatever is the team planning event, whatever is the risk assessment process, how it is being done, how is the understanding being taken, that is to be documented. Key element of the auditor understanding is to be documented. Very important source of information. So for example, we have a discussion with different departments. So that source of information, to whom we have discussed, when we have discussed, date, time, and what the question, what was the reply received. Another thing that is to be clearly documented in our work paper. The evaluation of design of identified controls and identified and assessed risk of material misstatement at the financial statement level and the adjustment level. So how auditor has assessed risk which impacting financial statement level at the adjustment level, that is to be documented. So one important aspect is significant risk and risk for which substantive procedure alone cannot give the comfort to the auditor, or the auditor cannot opine. So let me take one example here. So for example, in our retail store where the transaction size is very low. So for example, it may happen from rupees 5 to rupees maybe 1 lakh, and the number of transactions is so high. So when we visited some retail store, this happens there. So to have only the substantive procedure for the auditor, for those types of business may not be possible to do that. How many transaction auditor will do to take a comfort? So in that case, auditor has to assess some controls definitely should be there from with the discussion with the management, which management has identified and implemented. If those controls are not there, then auditor has to assess whether this substantive procedure alone can be done to have a comfort or to have a appropriate opinion or to reaching a conclusion. So that is very important aspect. So sometimes nature of transaction is such that control should definitely be there to have a proper making a proper opinion or obtaining the sufficient and appropriate evidence. So that should also come through through the documentation of this assessment. Okay, now I'll quickly touch upon some of the key revision in exposure draft, what is not there in SA 305 actually, and this is based on the exposure draft. So one is the introduction of 5 new inherent risk factors to aid in risk assessment. So I have touched upon this in a previous slide. One was the subjectivity, complexity, uncertainty, change, and susceptibility to misstatement due to management bias or fraud. So that I have covered upon in second or third slide, I believe. Second is a new spectrum of risk at the higher end of which lies significant risk. So for example, there is a retail store where auditor assess there is a very high likelihood that cash may be stolen, right? So because these are the small transactions and cash is at different places at various locations, right? So there is a very likelihood chance that cash may be stolen or cash may be doesn't exist, or maybe like you can say embezzlement of cash or something like that. But if we say the impact of that cash embezzlement, or that may not be very high because transactions are very small, they were at very various location, the balance of cash is very low. So in that case, likelihood is very high, but the significance or magnitude of that particular particular fraud may not be very high. In that case, this standard provides guidance that may or may not be a significant risk based on the professional judgment. So that has been added. The standard in exposure draft requires sufficient and appropriate evidence to obtain from the risk assessment procedure as the basis for the risk assessment. So that is a new addition in the exposure draft. Sufficient and appropriate evidence should be obtained by the auditor. A lot of things have been done on the IT side, so particular IT general control. So this standard include an exer there where certain types of, like for example, change management access, server backups, and other thing that is being covered there. That is currently not there in the SA 315, or maybe there but not so covered in so detailed. Next one is more on control relevant to audit and on the design and implementation work required for these controls. So this is another aspect has been added in exposure draft. Moving to the next slide, that is on key revision again. So one is removal of consideration specific to smaller entities. So earlier in the SA 315 there was a particular section, or you can say particular para, which deals with the smaller entities, how the auditor has to assess risk for the smaller entity. But in this standard, this smaller entity concept has been taken care of with the other para only. There is no separate section is there. And in the smaller entity side, this section may be more or less similar to the previous one to provide guidance how an auditor can assess where the policy and process is not so structured, not so formalized. I will cover that in the subsequent slide. So maybe some of the other key changes as compared to SA 315, 315 require inherent and control risk to be assessed separately. The inherent risk and control risk in the existing standard that can be combined. A difference between direct and indirect control. So I have touched upon briefly on the, like an example, I have taken a physical verification of inventory. That may be a direct control when it comes to the non-existence of inventory, and another side of the indirect control that supports the direct control. So that has been taken care of in the exposure draft. A new standback requiring reconsideration. So in case like when material class of transaction, account balance, and disclosure are not assessed as significant. So I again will take an example of disclosure of executive compensation when it comes to the significant risk. So auditor may assess that is not a significant risk, but when it comes to the materiality of the disclosure, the disclosure of executive compensation it may be very material to the financial statement. So this standard provides a reconsideration or this type of thing in the exposure draft. Now moving to the next slide. So that is for small entity. Little bit I have already covered. So when it comes to the small entity, it may be possible that small entity is not so structured. Their control framework is not formalized, but they have control. They have less people in the process to manage all the so, but they don't have so much of structured or documented procedure. So in that case, this is a auditor professional judgment. Maybe auditor can, like in previous slide, we discussed observation and physical presence. Auditor can observe how entities managing the control, what is the control framework, though it is not so structured, but how that has been actually implemented in substance as compared to form. So based on that, auditor can assess the risk of material misstatement and documented that. Definitely, an entity which have more complex system, ERP is implemented, other thing, they may have a more formalized and documented policy and procedure as compared to smaller entities. Okay, now moving to the next slide. So this is key differences from ISA 315. So there is a question. I'll start with the question. How many differences are there in standard on auditing as compared to international standard on auditing 315? So there are certain differences between the two Indian standard and the international standard on auditing. There are very few. So options are 1, 2, 3. Maybe quickly you can put in the chat box what is your answer to that. And then I will discuss this. What is the differences? Okay. So there are two differences. One is basically there is no specific reference to the public sector entities. So SA 315 apply equally to all entities, Indian standard on auditing, irrespective of their form, nature and size. A specific reference to applicability of the standard to public sector entity has been deleted. That is there in International Standard on Auditing 315. And second one is the group engagement side, determination of significant risk under SA 315. So international standard auditing 600 require more involvement by the group engagement partner if the significant risks relate to a component in a group audit. Basically, this corresponding requirement is not there in standard auditing 600 in India. So that's why this particular reference in SA 315 is also deleted. So basically, there are two differences as compared to International Standard on Auditing SA 315. Thank you. This all from my side. Now this house is open for question and answer. Happy to take any question, any query if you have.
Thank you, sir.
Yeah, Mohit.
Thank you so much, sir. Now we will discuss about the question and answer.
Yeah.
So one question is there is, after identifying the risk of material misstatement, whether it is required to reinstate the financials.
I think question is good, but two things have been merged. So one is the standard when we are talking about. So this is in between the audit when we start the audit. So when we plan the audit and then we start identifying the risk of material misstatement, right? So when we say very quickly, when we say identifying risk of material misstatement, so what can go wrong? So for example, I have taken certain example. Inventory may not exist, trade receivable may not exist, trade receivable may not be fairly valued as per accounting standard. So this is the risk which are there before signing an opinion. So this standard helping us the planning and the steps in our audit and then finalize the opinion. The question is, I think, once the financial statement has already been signed and auditor comes across any observation, maybe in the first year of audit or maybe in the previous year audit. So in that case, there is a guidance available in accounting and auditing standard. So that needs to be restated. That needs to be restated based on the guidance available. In that case, third balance sheet would be there. Hope this answer the query.
Thank you, sir. Now I have no more questions.
Sir, most of the questions have been answered. You have asked during your presentation, yes or no. So most of the members are asking. So kindly you could throw on those questions only and explain once again, sir.
Okay.
Because they have mentioned only yes, no, so they are requesting to please explain those questions once again, sir.
Okay, I'll quickly do that.
Ji, please, sir.
Okay. First question I have taken on the screen. Have you ever seen this responsibility paragraph and where? And auditor, this is being used very frequently. So this was quite simple in our auditor report. If we see, every auditor has to give auditor responsibility for the audit of the financial statement, where we see reference of this standard, whether we have assessed material misstatement due to fraud and error and other thing. That was one. Second was on, yeah, this is important. Is it necessary to document how and when this inquiry process? Is it not there? Okay, I'll say. Yeah, thank you. So second question was, is it necessary to document how and when these inquiry procedures were performed and risk assessment based on set procedure? So happy to answer if somebody is asking again this question, because this is very important. So once we have performed this procedure and we have documented, we have not documented these things. So once it comes to the regulator, it comes to the NAFRA and other agencies, so that would not be considered as an audit, because that is not there in the working paper. So it is very important to document those names, time, and date, to whom we have discussed, what was the question asked, and what was the reply, and based on that replies, what is our final risk assessment. Now comes to the one more. So can auditor use external source of information while assessing risk of material misstatement? Yes, that is very important. So auditor should use all the source of information, that may be internal, that may be external, and that may be financial, non-financial as well. So answer is yes for that. Moving to the next one. So yeah, I have one question on, is it necessary to involve all team members in the team discussion? So that is also very important. So is it not particularly necessary to have all team members in the team planning event or the discussion, but the auditor or the partner has to decide what is the key critical matter to be communicated among all the team members. So that is one. Okay, so is it possible to reassess risk of material misstatement? So this is again very dynamic and the continuous process. So whenever auditor has information, so auditor has to assess that risk of material misstatement at every stage of the audit, maybe each and every stage of the audit. If some information auditor has that is inconsistent from the previous assessment, then auditor should quickly reassess the thing, design their nature, timing, and extent for that. Okay, the last one is the difference. There are two difference that I have already covered. Okay, so this is better. Yeah.
Thank you, sir.
Yeah.
Hello.
Thank you so much, sir, for providing me this opportunity to host the event. Or Surinder sir, we are very much thankful to you कि आप जो है सर हम मेंबर्स की जो है नॉलेज को एनहांस कर रहे हैं अपनी सर्विस देकर, और जो है हमारी मदर बॉडी का नाम रोशन कर रहे हैं सर. थैंक यू सो मच सर.
Thank you very much, sir. Yeah.
Yes, please, sir, you were saying something.
No, I was just saying thank you for organizing this session and giving this opportunity to speak here. Yeah.
Sir, thank you so much, sir, on behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountants of India, for your valuable suggestions, as well as your you have thrown light on various intricacies on SA 315 revised with the vis-a-vis the exposure draft which WSBF came out, and you have enlightened all of us on various aspects of the same. So thank you so much for sparing your valuable time on behalf of WSB of ICI. Heartiest thanks towards you, sir. Also, we are thankful to the Honorable Chairman Sirsa Bran, C. Mohit Gumbarji, for sparing your valuable time and moderating this event and co-hosting this webinar jointly with the WSB of ICI. Thank you so much, sir. Thank you so much, Chairman, sir. Thank you so much, Surendra ji. Thank you so much.
Thank you, everybody. Bye bye. Good evening.
Thank you. Namaste. Namaste.